Hey guys, Jarrett White with White Ridge Mortgage back again today with another video on every single first-time homebuyer program and incentive you get here in Canada. We're gonna debunk all the myths and go over every single program you have available to you and all the things within them that you're gonna wanna consider. But before we get started, please hit that subscribe button, ring the bell to be notified, and hit that like button so this video gets pushed out to more people just like you. It would be so much appreciated, more than you could ever imagine. Okay, let's dive right in. So as a first-time homebuyer, you may have heard of having some special programs and incentives available to you, one of which you may have been told is purchasing a home with less than 20% down. In fact, you may have even heard that you can purchase a home with as little as 5% down. I want to clear the air once and for all on this. And this is true, but it's not a first-time homebuyer benefit. There are only 3 things you need to know to be able to buy a home with less than 20% down, and being a first-time homebuyer is not one of them. Number 1, the property has to be owner-occupied, meaning you're intending to live in the property. Number 2, you have to pay for mortgage default insurance. This is an insurance that gets added onto your mortgage amount, and it's in favor of the lender, not you. And number 3, the home has to be under $500,000 if you want to purchase with 5% down. If it's over 500, between 500 and $1 million, you have to put 10% down on just that remaining portion. So an example of this would be if you have a $600,000 home you want to buy, it's 5% on that first $500,000, so $25,000, and then 10% on that remaining $100,000, so $10,000. So your total down payment on a $600,000 home would be $35,000. But enough of that. We're not here to talk about down payment. We're here to talk about all the amazing programs that the government has available for you as a first-time home buyer. We're gonna go through them all really quickly here, and then I'm gonna go into each single one in detail. That way you fully understand what's available to you. So number 1, we got the first-time home buyer savings account, otherwise known as the FHSA account. This is essentially an investment account, not actually a savings account, and it functions similar to an RRSP, a retirement savings plan. For those of you that don't know what that is, every single year you're able to put $8,000 into this account, and that money is considered a tax credit. Now what that means is come tax season, you're gonna pay less income tax on the amount of income you made because they're deducting $8,000 from it. So to make this very easy to understand, let's just have an example of someone making $100,000. They would normally get taxed on making $100,000. However, if they put $8,000 into their FHSA account, they're no longer being taxed on $100,000, they're gonna be taxed on $92,000. However, if you're employed, you've probably been making all your tax payments throughout the year. Therefore, come tax season, when your accountant does your taxes, you're actually gonna get a return back because they've charged you too much income tax. Now, an $8,000 tax credit typically means about $1,500 to $2,000 in a return, so it's basically free money if you're to open this account. Now there's a couple features that make this account really special. Number 1 is there's no minimum timeline that money needs to be in the account. So you could put it in, the day later, take it out, and still get that tax credit. So even if you're in the process of buying a home right now, it would still be worth it to open the account, dump some money in there, pull it out the next day, and still get that tax credit. At the end of the day, it's free money. And number 2, once the money is taken out when you buy your first home, the account is closed and you no longer have to pay money back into that account. You can open an FHSA at pretty much any bank, and it's important to know that the limit carries over. So even if you don't put money into it in the first year, the second year, instead of having an $8,000 limit, you're gonna have a $16,000 limit. So I highly recommend you open one up sooner than later. Number 2 is the RRSP Homebuyers Plan. This is where you can actually use money from your retirement savings for your down payment. It's very similar to the FHSA account. However, with this one, there are a couple different rules. So with the FHSA account, you can withdraw up to $40,000 as a maximum, whereas the RRSP account maxes out at $35,000. Keep in mind, this is per person, and you can stack both of these together. Now, the downside to the Homebuyers Plan versus the FHSA is the Homebuyers Plan, since it is an RRSP, it has the same rules of $8,000 a year and having that tax credit, However, the money has to sit in that account for 90 days. Not only that, but when you do take money out of this RRSP account and use it towards your down payment, you are actually required to pay that money back into your RRSPs over the next 15 years. So if you were to choose one or the other, I would highly recommend the FHSA because you're not required to pay it back over the years. There's no minimum timeline the money needs to be in there. It's just all around a better program. However, if you already have money in your RRSPs, why not double up if you can? Number 3 is your first-time homebuyer's $10,000 tax credit. I'm not gonna go too much into detail on this one because it's literally exactly how it sounds. When you buy your first home, you get a $10,000 tax credit that calendar year. So think of this, if you were to get your first-time homebuyer's tax credit of $10,000, your RRSP tax credit of $8,000, and your FHSA tax credit of $8,000, that's $26,000 of a tax credit. You're gonna get one massive tax return come the end of the year. Number 4 is your property transfer tax exemption. Keep in mind, I'm gonna be talking about BC, British Columbia, Canada, because each province is a little bit different with how they charge their tax. However, I'm pretty sure even in other provinces, you still get the tax exemption based on the same limits. So property transfer tax is a tax that you pay when you buy a home. Doesn't matter whether it's your first home, second home, third home, every single time you buy a home, you have to pay property transfer tax. And it's calculated as 1% of the first $200,000 of the purchase price and 2% of the remaining amount up to $2 million. Now, to put that in perspective, a $500,000 home would be $2,000 on that first $200,000, and then that last $300,000 would be at 2%, meaning $6,000. So you would have a total tax bill of $8,000 for buying a $500,000 home. Now, previously, the rule was if you buy under $500,000 as a first-time home buyer, you do not have to pay any property transfer tax. However, they have since increased the limit of that threshold. So now instead of $500,000, as long as you're purchasing under $835,000, you still get that $8,000 discount. However, you do have to pay 2% of any amount over $500 to $835. So an example of this, if you're buying a $650,000 home, you're not paying on that first $500,000, you're only paying on that last $150,000, and the rate is 2%, so you're gonna have a $3,000 tax bill instead of an $11,000 one that you would have had before. This new property transfer tax guideline comes in effect April 1st, 2024, so by the time you buy a home, you're likely gonna be past that date, and these are the rules that you're gonna go by. And number 5, it actually no longer exists, but I wanna make sure you know what it was. That way, if you've heard about it before, you know that you can no longer get it. And this was the Government Shared Equity Program. So the government actually had a program for first-time homebuyers where they would gift you 5% to put towards your down payment. Now, while that sounds amazing, it was actually a terrible program and pretty much no one used it, and that's probably why it's gone. Now, the reason why it's a terrible program is they're not just gifting you the 5%, they're actually buying 5% of the equity in the property. So when you do have to pay them back, either by selling or over 25 years, you don't just pay them back the 5% they gave you, you actually pay them back 5% of the current market value of your home. And in Canada, we all know home prices tend to go up, so 10, 20 years from now, that 5% could equal a whole lot more than it did the day they gave it to you. But anyways, that program is gone. It is no longer available. They just wiped it off the face of the earth, literally instantly, no warning. But in case that was something that you were relying on, I wanted to make sure that you knew it's now gone. So there you have it. Those are all the programs you have available to you as a first-time home buyer here in Canada. If you have any more questions about them, don't hesitate to reach out, leave a comment, go to the website, book a call, whatever you think is best, and I'm more than happy to explain them to you in more detail. Thanks a lot for watching. Please hit that like button, subscribe, ring the bell to be notified, and I'll catch you on the next one. See you later.